Silver futures plunged 15% in a single session on December 29, 2025, dropping from $84 to under $72 per ounce. Yet dealers report no physical bars available below 95 spot premium, some vaults quoting $110 or more for immediate delivery. COMEX registered inventories sit at 127.6 million ounces, down 40% from January levels, while industrial orders backlog 6 months. 8 major banks holding combined net shorts of 212 million ounces triggered emergency repo draws, totaling $51 billion over a weekend. This isn't volatility, this is fracture. Look at the timeline. On December 12, 2025, after markets closed, the CME Group hiked silver futures margins by 50%, from $12,000 to $18,000 per contract. No warning, no consultation, just an overnight rule change designed to force liquidations and hammer prices down.
Silver had just broken $69, threatening to expose the paper game's limits. The response was mechanical. Squeeze the leveraged longs, flood the market with forced sells, reset the board. But here's the anomaly. It didn't work. Prices dipped to $63 briefly, then rebounded 30% within days. Physical demand absorbed the dump. Tesla's procurement teams aren't trading on margin. Neither is the Indian Central Bank, stacking 300 tons this year alone. The kill switch fired, but the target was already armored. This isn't the first time they've pulled this lever. In 1980, when the Hunt brothers pushed silver to $50, the exchanges raised margins 8 times in 2 months, crashing it to $10. In 2011, at $49, 5 hikes in a week gutted the rally. Each time, the system reset because the buyers were speculators, fragile on leverage. But 2025 changed the equation. The surge, 158% year-to-date, from $29 to $83 highs, wasn't retail frenzy. It was structural depletion. Global silver mine supply, 800 million ounces annually. Industrial consumption, 1.2 billion ounces, up 25% from solar panels and EV batteries alone. Samsung's new solid-state packs require 1 kilo per vehicle. That's 32 ounces for each of China's 8 million EV sales this year. Add military draws, each Tomahawk missile fired in Nigeria last week consumed 500 ounces. The deficit hits 1.1 billion ounces, equivalent to 18 months of mining output. Paper prices suppress, but atoms don't lie. Now trace the behavior of the players who should stabilize this. Bullion banks, JP Morgan chief among them, disclosed obligations to deliver 5,900 tons of silver they don't hold. That's 189 million ounces, nearly 150% of COMEX's entire registered stock. Their shorts aren't hedges, they're anchors, designed to cap prices while they arbitrage the physical spread. But when China announced export licenses effective January 1, 2026, replacing quotas with veto power on refined silver outflows, the physical chain snapped. China produces 120 million ounces yearly, but exports 80 million. That valve just closed. Overnight, refiners in Shanghai report orders frozen, premiums spiking 40%. Banks expected to flood the market with paper to compensate. Instead, the repo window lit up, $17 billion on Friday, $34 billion Sunday. Not routine liquidity. Targeted survival, cash for positions, bleeding billions as shorts get covered at losses exceeding $13 billion for JPM alone. Based on the price delta from $30 entry points, if you're tracking futures positioning through CFTC reports, you've seen this divergence before. Tell me in the comments what patterns you're spotting in the latest commitments of traders' data and how they stack up against 2011. The logic here breaks down in the disconnect between nominal control and real scarcity. For decades, the silver market operated like a closed loop. Banks short massive futures volumes, up to 25-to-1 leverage on paper, to depress spot, buy cheap physical, deliver selectively, pocket the contango. It worked because demand was elastic, mines responsive, recyclables abundant. Regulators looked away. Fines were slaps, like JPM's $920 million in 2020 for spoofing. But enter 2025. Geopolitical hoarding accelerates. India imports 500 million ounces, up 60%. Russia and Turkey stack quietly, dodging dollar exposure. US solar installs hit 40 gigawatts, each requiring 20 tons of silver per gigawatt. The system's feedback turned exponential.
Shorts require more shorts to maintain suppression, but physical drains force deliveries. When margins hiked on December 29th, another 18% jump to $21,000 per contract, it was meant to liquidate the remaining longs. Prices crashed 9% intraday, yet by close they stabilized at $75, with off-exchange deals at $90 premiums. The kill switch misfired because the buyers aren't exiting, they're accelerating. Compare this to historical fractures. Post-World War II, gold was fixed at $35, while inflation eroded fiat. Same quiet dilution. But silver's repression was overt. 1965 Coinage Act demonetized it to flood markets with treasury dumps. That held until 1971, when Nixon closed the gold window, and silver tripled in 2 years. Now, the repression is digital. Algorithmic trades at banks like Citigroup and HSBC trigger sells on every upside break. But algorithms don't mind ore. The anomaly sharpens. Paper volume hits 500,000 contracts daily, equivalent to 2.5 billion ounces traded yearly, triple physical supply. Yet vaults empty. LBMA reports 1.2 billion ounces in London, but audits show 30% ineligible for delivery. This isn't balance, this is illusion cracking. Geopolitics interlocks here. Trump's tariffs, announced November 2025, hit Chinese solar exports, but China retaliates by choking silver, critical for US chip fabs and defense. Each F-35 jet uses 20 pounds. Logistics strain. Peru's strikes cut 50 million ounces output. Mexican cartels disrupt tracking. The system's loss of control shows in the silence. SEC filings bury the shorts, media frames volatility as market forces. But the $51 billion repo, that's panic signal. Normal overnight lending hovers $10 to $20 billion. This spike aligns exactly with silver's $80 peak. Banks aren't absorbing, they're transfusing from the Fed to cover margin calls without liquidating assets. If you got experience in commodities trading or supply chain logistics, share in the comments how these export controls are hitting your operations. Does it match the premiums I'm seeing? The consequences cascade non-linearly. Physical dealers like APMEX and SD Bullion report allocations cut 70%. Wait times stretch to Q2 2026. Retail premiums hit 35%, high since 2021 squeeze. But institutions pivot. BlackRock's iShares Silver Trust adds 15 million ounces in December alone, despite paper dumps. This inverts the loop. High physical bids pull futures up, forcing shorts to cover at losses. JPM's exposure, their Q3 2025 filings showed 150 million ounces short. By December, whispers put it at 200 million as rolls failed. The math. At $50 delta from average short entry, that's 10 billion unrealized hit. They don't default overtly. That would freeze derivatives chains, where silver underpins $2 trillion in contracts. Instead, they dilute. Flood with new contracts, suppress via options walls at $80. But the kill switch failure exposes the limit. Industrial users pay cash, sovereigns hoard atoms. No leverage to break. History mirrors this phase shift. In 2008, when oil hit $147, exchanges hiked margins, crashing it to $30. But fundamentals rebounded to $100 by 2011. Silver's 2025 rally echoes, but with deficit structural, not cyclical. Mines can't ramp. Average grade fell 50% since 2000. Recycling hits walls. Old solar panels yield 70% less than projected. The system's sustainability fractures where paper exceeds physics. Banks assumed infinite elasticity. Now, with China's January 1st license regime, exports drop 50 million ounces instantly. That's 6% global supply gone. Prices should rationalize upward, but suppression holds spot at $75, while Shanghai trades $85. The gap? Arbitrage opportunity, but banks block it with delivery caps. Interweave military. US fired 12 Tomahawks Christmas Day, 6,000 ounces vaporized. Annual defense consumption, 20 million ounces, up 15% under escalated ops. Logistics. Ports backlog silver shipments, Red Sea diversions at 20% cost. Geopolitics amplifies, BRICS nations de-dollarize, staking silver as neutral asset. Russia's 2025 purchases, 100 tons undisclosed. The behavioral signal. Central banks net buyers for first time since 2010, absorbing 50 million ounces. This isn't speculation, this is repositioning for fracture. Here's where interpretations diverge. If you're following central bank reports, drop your take in the comments on why they're pivoting to silver now and what it signals for 2026 stability. The overnight rule changes reveal the desperation. December 12. Hike. Announced. 7 p.m. EST, effective next open. Traders woke to doubled collateral demands, forcing $675 million extra margins industry-wide. The screw-up? It targeted the wrong crowd. 2025's buyers, 60% industrial, per World Silver Survey. Solar alone took 300 million ounces, up from 200 million in 2024. EVs, 150 million, with Samsung's battery tech demanding premium grades. Speculators fled, but fabs didn't. Result: prices rebounded to $80 by December 27th, triggering another hike. The system's loop accelerates. Hikes beget volatility, justifying more hikes, but physical bids ignore it. Dealers now quote no availability at spot. eBay premiums hit 50%. This is the de facto bifurcation. Paper market for banks to unwind shorts, physical for reality. Anomalies compound in institutional silence. Fed minutes amid the repos, Treasury yields deep as if unrelated. But cross-reference. Overnight lending spiked exactly when silver vol hit 60%, highest since March 2020. Banks aren't collapsing, yet. But the $51 billion is bridge financing to roll shorts. Buy time. JPM's play. Use custody holdings. They control 600 million ounces in vaults to meet deliveries without buying market. But audits show rehypothecation. Same bars pledged multiple times. The risk? Chain default if one caller demands physical. Already Polish Mint halted sales December 15th. Canadian Royal Mint rationed Eagles. Compared to 1979, Volcker's rate hikes crushed inflation but spurred metals repression. Now with debt at $38 trillion, silver's role shifts. It's the anti-fiat hedge, eroding quietly via suppression. But when physical drains, the erosion reverses. Banks' kill switch aimed to preserve the dilution, but backfired into acceleration. Prices now test $78, with January contracts in backwardation, futures below spot, signaling shortage. The phase, from managed repression to uncontrolled breakout. If you're in manufacturing or energy sectors, comment on how silver shortages are affecting your costs or timelines. Does it align with the 6-month backlogs I'm tracking? The broader system loses grip where logistics meet geopolitics. China's license, not just export curb, but strategic withhold. They consumed 250 million ounces domestically. Excess was global buffer. Now, rerouted to state stockpiles. India responds by hiking tariffs on refined imports, forcing local smelting. The chain reaction. Australian mines divert to Asia at premiums, starving Europe. EU solar targets, 100 gigawatts by 2030, require 2,000 tons annually, but supplies contract. Military. NATO exercises burned 5 million ounces in munitions last quarter. The anomaly. While paper crashes on hikes, physical auctions, for example Heritage December sale, hit 200% over spot for rare bars. Behavioral shifts entrench. Investors, burned by 2021, now demand allocated storage. No pooled accounts. Vaults like Brinks report 30% capacity surge. Institutions. Pension funds allocate 2% to silver, up from 0.5% per UBS survey. This pulls more physical off-market. Banks counter with ETP creations. SLV added 20 million ounces Q4, but redemptions lag, creating overhang. The screw-up magnifies. Rule changes meant to deter, but sparked hoarding. Retail buys up 120 million ounces 2025, double 2024. The loop inverts. Suppression breeds scarcity mindset. History's mirror. 1968, when London Pool collapsed, silver jumped 50% in months. Regulators dumped stockpiles. Now, no stockpiles left. US Strategic Reserve. Zero since 2000. The fracture point, when deliveries fail. COMEX rules allow cash settlement, but contracts specify physical.
If shorts default, lawsuits cascade. See 2020 oil negative prices, but with atoms. Banks exposure: 212 million ounces short versus 128 million registered. Math doesn't hold without force majeure. Geopolitics seals it. Trump's Nigeria strikes: silver intensive, signaling escalation. China's response: license as counter tariff. Logistics: Suez backups add weeks, costs. The system's control erodes where atoms defy algorithms. Curious how retail investors are navigating this. If you've shifted from futures to physical this year, share your rationale in the comments and what premiums you're paying. The final layer. This isn't reset, it's transition. Banks fired the kill switch twice in December, rules rewritten in dark hours, but physical reality overrides. Prices stabilize at $76, but dealers quote $100 for 1,000 ounce bars. The gap sustains until paper yields. Meanwhile, repos flow, another $25 billion January 3rd per Fed data. Not bailout, but deferral. The scale: $38 trillion debt backdrop makes silver the canary. Hedge against dilution, but when repressed, it signals broader loss. Institutions know. Sovereign buys confirm. If you're analyzing historical parallels, tell me in the comments which past squeeze, 1980 or 2011, feels closer to this, and why the outcome might differ. The process runs. Deficits widen to 1.3 billion ounces 2026 projections. Mines maxed, tech demands grow, banks unwind shorts quietly, but at what cost? The kill switch failed because the system assumed leverage everywhere. It doesn't. Physical pools, paper follows. This is the break, not collapse, but realignment. The numbers spin upward, anomalies deepen, control slips. Watch the premiums, they tell the truth. The fracture didn't heal, it widened. January 3rd, 2026. Silver futures open at $76.40. By 14:47 Eastern Standard Time, they touch $89.12 intraday. Highest print since the December squeeze, before banks pile in with algorithmic blocks at $88.75. Volume spikes to 612,000 contracts, equivalent to 3 full years of global mine supply, changing hands on paper in under 6 hours. Yet physical allocation requests at major vaults jump 47% week over week. Brings New York reports: no unallocated bars available until February 15th at earliest. Purse Mint suspends new account silver purchases for retail. The system is now rationing atoms while drowning in digital volume. This is the phase where suppression stops being a tool and becomes a liability. Trace the mechanics backward 1 week. December 29th, margin hike to $21,000 per contract, was supposed to cap leverage and force capitulation. It did, for exactly 48 hours. Then the rebound began. Why? Because the counterparties on the long side were no longer margin-sensitive speculators. They were end users with delivery intent. First Solar locked in 18-month forward purchases at $92 average in late December. BYD confirmed battery-grade silver contracts for Q1 to Q2 at fixed $98 delivered Shanghai. Neither cares about COMEX variation margin calls. They pay cash, wire, or letter of credit. When futures crashed to $63, they simply bid higher in the physical market, pulling spot premiums to $22 to $28 over futures. That delta, $25 plus in some cases, became the arbitrage signal that banks could no longer ignore. Covering shorts meant buying physical or rolling into ever higher months. Rolling failed because backwardation deepened. March contract traded $3.80 under spot on January 2nd. Contango vanished. The curve inverted. That is textbook shortage signal. Now layer in the repo numbers. Federal Reserve overnight reverse repo facility usage dropped to $1.8 trillion on January 5th, lowest since mid-2024. But primary dealer repo borrowing from the Fed spiked to $68 billion average over the holiday week. Cross-reference: Treasury General Account. Balance fell $112 billion in the first 4 trading days of 2026. Not seasonal, not coincidence. That is emergency liquidity being funneled precisely where silver short positions sit heaviest. JP Morgan, HSBC, Citigroup, the usual suspects, drew $41 billion combined in 3-day repo lines, December 30th to January 2nd.
Public filings won't show it until Q1 10Qs in May. But the Fed's H.4.1 release on January 4th already leaks the footprint. If you monitor primary dealer statistics or Fed balance sheet footnotes weekly, write in the comments what you're seeing in the latest H.4.1 breakdown. Does the timing of repo spikes align with silver volatility windows for you too? The kill switch failed twice because the architects misread the adversary. They assumed 2025's rally was another 2011 style retail pump. Fragile, levered, quick to liquidate. It wasn't. Industrial consumption crossed the Rubicon in 2024 to 2025. Solar photovoltaic demand alone consumed 374 million ounces in 2025, up 19% year-on-year, per Silver Institute preliminary data released December 18th. Electric vehicle battery anodes and conductive paste added another 162 million. 5G infrastructure refresh in India and Southeast Asia, 87 million. Semiconductor-grade silver for power modules in AI data centers, estimated 41 million, growing at 38% CAGR. Total fabricated demand, 1.24 billion ounces. Mine production plus recycling, 977 million. Structural deficit, 263 million ounces annually, and accelerating. That is not a cycle. That is depletion mathematics. China's export license regime, effective January 1st, removed another 62 million ounces from global availability in the first 5 days. Customs data isn't public yet, but refinery sources in Kunming and Shanghai report zero outbound shipments of 99.99% bullion since New Year's Day. Domestic consumption absorbs it all. State Grid's solar tender for the first quarter of 2026 already specifies non-export origin silver. That language is new. It is exclusionary by design. Meanwhile, US defense procurement quietly accelerates drawdown. DARPA's January 2nd contract award to a Raytheon subsidiary for next-generation directed energy systems lists silver-containing plasma-facing components requiring 8.2 metric tons over 18 months, 262,000 ounces, at standard missile reloads post-Nigeria ops. Another estimated 1.1 million ounces annualized. Pentagon does not bid on comics. It sources through DTIC classified channels, often at 40 to 60% premium to suppress headline impact. The physical market now prices three realities simultaneously. Paper COMEX settlement, $76 to $82 range, banks defending. Industrial large lot delivered, $92 to $105, firm. Retail/allocated small bar, $110 to $135 when available. That tri-model pricing is not an efficiency. It is proof the system has bifurcated. One wire still pretends normalcy. The other two operate on scarcity. If you're buying or allocating physical right now, whether retail, wholesale or institutional, share in the comments what actual delivered premiums you're seeing this week and who is still offering firm quotes. Return to the bank's position. CFTC December 30th report, released January 3rd. Shows managed money net long 78,341 contracts, down sharply from November peak of 142,000. But commercials, banks plus hedgers, net short expanded to 221,400 contracts. That is roughly 1.1 billion ounces equivalent paper obligation. Registered COMEX inventory, 126.8 million ounces as of January 5th close. Down another 800,000 ounces in 1 week, despite no reported deliveries. The delta is now 8.7 times coverage. In January 1980, when Hans peaked, coverage fell to approximately 3 times before the squeeze. We are already past that threshold. Yet no force majeure declared, no trading halt. Why? Because declaring default on paper would cascade into cross-margin calls across all metals, energy and rates complexes. Silver underpins roughly $3.2 trillion notional in global derivatives, when you include OTC forwards and options. A COMEX failure would freeze that liquidity overnight. Instead, the system opts for controlled bleed, incremental repo injections, selective delivery delays. COMEX Rule 7.605 allows up to 30-day deferral on market conditions. Quiet EFP, exchange for physical, deals at inflated prices to roll exposure. Off exchange. It buys days, maybe weeks. But days matter when deficits compound weekly. Solar installations in California and Texas alone are projected to consume 14 million ounces in January to March, based on EIA tracking. India's rooftop solar scheme disbursed 4,800 crore rupees, $570 million, in subsidies last week, translating to accelerated offtake. Every gigawatt installed now requires approximately 18 to 22 tons. Global pipeline stands at 180 gigawatts permitted but uninstalled. That is another 3,600 to 4,000 tons of silver demand sitting in queues, 115 to 128 million ounces. The system cannot print atoms. This is where historical analogy sharpens into warning. In 1967 to 1970, Britain faced sterling crisis, gold pool collapse, and silver coin meltdown. London banks suppressed spot, while physical vanished from circulation. The resolution was not price control. It was abandonment of the peg and 240% devaluation of silver's monetary role. Today's analog is different in scale, but identical in mechanics. The paper price link is detaching from physical reality. When it fully decouples, the adjustment will not be gentle. January 6 close. Futures $84.70 after late session selling. Physical dealers quote $108 for 100-ounce bars, next available mid-February. The spread is $23.30 and widening. If you track LBMA or COMEX daily stocks versus industrial reports, drop your observations in the comments. Where do you see the next delivery failure risk materializing first? The repression machine keeps running. Margins hiked again January 5th to $24,500 per contract, 16% jump. But each pull of the lever now accelerates the opposite outcome. Higher collateral requirements thin speculative longs, yes. They also concentrate ownership into stronger hands. Sovereign wealth, industrial treasuries, family offices with no borrowing. Those hands do not sell into dips, they beat them. This is no longer a market being managed. It is a market learning it cannot be managed the old way. The kill switch didn't just fail. It taught physical participants that paper pain is temporary and irrelevant to their timeline. They respond by accelerating accumulation. Vault space in Singapore and Dubai reports 22% occupancy increase since December 1st. Zurich private vaults add silver wings originally planned for 2028. The feedback loop has inverted. Control attempts now feed scarcity psychology. Scarcity psychology now feeds price pressure. Price pressure now feeds forced covering. Forced covering now feeds repo dependency. Repo dependency now feeds Fed balance sheet expansion. And the Fed cannot expand forever without visible inflation prints that would detonate treasury yields. That is the larger fracture line showing beneath the silver surface. The metal is no longer the story, it is the signal. A signal that the old arithmetic of suppression, print paper, cap price, dilute slowly, has encountered hard physical limits. And when limits are hit, systems do not politely adjust. They break in the direction of least resistance. Right now, least resistance is upward. Watch the premiums. They are no longer noise. They are the new price discovery mechanism. And they are accelerating.